Welcome to the second video of the module devoted to ethical and governance issues. In the previous section you got acquainted with the notion of stakeholder conflict and the concept of corporate governance. In this video we will be discussing the methods used to evaluate management performance. As you may expect, the directors of a company tend to act in accordance with the expectations and requirements of shareholders, providing their performance is monitored and evaluated. Management appraisal is typically based on an assessment of whether the targets which they were assigned were achieved or not. In many institutions, manager objectives include a mix of both financial and non-financial goals. Financial targets used in management appraisal may refer to accounting ratios or stock market figures. Examples of the first are earnings per share or return on capital employed. It is worth noting, however, that application of such metrics to the appraisal of managers has been subject to criticism because measures such as earnings are not directly linked to shareholder wealth. Use of the dividend per share ratio eliminates this drawback. However, it should be noted that there are situations in which dividends are not paid out, while shareholder wealth still increases. For example, when a company reinvests its profits in investment projects with positive NPV. In such cases, linking management evaluation to dividends is obviously inadequate. Some companies incorporate even more sophisticated measures into management appraisal, such as economic value added or EVA, which is a more accurate measure of shareholder wealth because it takes into account the capital structure of the company. Examples of stock market metrics used to evaluate managers are the price-to-earnings ratio or simply the company's share price. Again, use of such measures is far from perfect, and that's because share prices may fluctuate in reaction to external factors, which may be independent of the decisions taken by the company's management. A measure which is better suited to the appraisal of managers than accounting and stock market ratios is shareholder value added, referred to as SVA, which specifically measures the improvement in cash flows generated by a company for the benefit of its owners. It should be noted, however, that the computation of SVA is a complex process, and this has a negative bearing on the popularity of this approach. As a result, the majority of companies do not build their management evaluation schemes solely on financial metrics, but incorporate non-financial measures into the process as well. For example, management evaluation may be based on a balanced scorecard, which allows for the assessment of a company's performance from various angles, which include, apart from financial results, other perspectives such as customer satisfaction, the level of innovativeness, quality of business processes, and many other, depending on the company's mission and characteristics. You should be aware that management appraisal does not necessarily have to be linked to ratios and measures which relate to the company as a whole. Many firms assign their managers individual targets connected strictly to their area of competence and responsibility. These targets can either take the form of specific cost or revenue objectives or non-financial targets, for example, linked to employee satisfaction ratings or staff turnover. Let us now concentrate on the way companies report their results to the public. Depending on jurisdiction, a publicly traded firm has to periodically issue a set of information to the market. Such a set typically comprises the financial statements, which in many countries have to comply with international financial reporting standards, as well as non-financial reports, as required by local commercial law and stock exchange regulations. Naturally, the main goal of financial statements is to provide information about the financial situation and performance of the reporting entity. However, financial reporting frameworks such as IFRS also require companies to disclose a great deal of qualitative information, allowing readers to learn about other aspects of their performance, such as how they are managed, how they approach environmental issues and social responsibility, and many others.